Dockworkers walk out of every major port on the US East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun, quote, targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. Plus, Fed Chair Jerome Powell says he's in no hurry to lower rates, while reiterating the United States economy remains on solid footing. Welcome to the programme, everybody. Let's take a quick look at what is playing out in front of us in terms of the European session. We're sort of either side of the flat line here. The FTSE 100 up by 0.4%. The DAX a little stronger. The CAC 40 on the back foot today. We see some of the luxury names under pressure. We've seen a downgrade to some of the luxury players from one of the banks, and that could be weighing on Paris just a little bit. Broadly then treading water overall for European equity markets. In terms of individual assets we're focusing on, this is the futures picture for the US. This the epitome of treading water, really waiting for some direction here, watching the strike action taking place in the ports in the on the east coast of the United States and down into the Gulf as well. Also watching geopolitical developments, of course, and with that in mind, quickly checking where we are on Brent. We're actually a little weaker now. We did tick up a little overnight on the Brent price, but now at 70.86. European gas futures also a little bit weaker, and dollar yen dictating the direction at least a little of the Nikkei, as we saw in Asia trading overnight. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in London. Francine Lacqua will be with us this hour. She's at the Berlin Dialogue, the Berlin Global Dialogue. We've already heard her in conversation with Larry Fink this morning. Plenty more coming to us from Francine and that dialogue as we go through this programme. Let's turn to geopolitics. Israel says it has begun what it describes as targeted ground raids in southern Lebanon, defying international calls for restraint. The military has been striking targets in villages close to the border that pose what it says is an immediate threat to communities in northern Israel. Let's get more now with Bloomberg's Stuart Livingston-Wallace, who can bring us up to date from the region. Stuart, an update on what we're seeing overnight from Israel and the objectives they describe attached to this operation.
Yeah, good morning, Anna. So at the moment, it's very hard to tell what exactly is going on. We know we've seen some reports of explosions on those villages, as you mentioned, along the border. But there have also been similar incidents along the coastal areas and again in Beirut. So just to remind everyone, this sort of comes at the tail end of a couple of weeks of really very intense airstrikes in Lebanon. And that's really aimed at two things. One is to eliminate the Hezbollah leadership. And so far, Israel says it's eliminated something like 10 out of 11 of the most senior leaders. And secondly, to degrade the weapons stockpiles that Hezbollah has across. So most of that has been focused on the Bekaa Valley and then the southern suburbs of Beirut, because those are the Hezbollah strongholds. But what you've seen this morning, I think, is a realization from Israel, or an acceptance from Israel, that airstrikes alone are not going to be able to do the full job in terms of eliminating that threat to its citizens in the north of Israel. So fundamentally, Netanyahu, the Israeli Prime Minister, expressed one of his war aims is to be able to move his citizens back into the north of Israel. So they've evacuated from there for many months. And that is really fundamentally what they're trying to do here. The real risk is how long they have to stay to get that done. And really, they may get bogged down and find themselves back in the same situation they were a couple of decades ago, where they had to effectively stay in southern Lebanon for years and years. That is not the intention here. That is clearly not their stated goal, but that is one of the risks.
Stuart, thank you very much. Thanks for the update. Bloomberg's Stuart Livingston-Wallace with the latest on what we're seeing developing in Lebanon. You can follow what is happening, the latest coming to us from the Middle East on a Bloomberg Top Live blog. That's on the web and on the terminal with the latest on the Middle East situation. TLIV Go is the function to use on the Bloomberg terminal, or you'll find it on our website. Let's just get to some breaking corporate news coming through, and this coming from Lufthansa. The CEO speaking at a press briefing. He's talking about the gap. Says that the gap between the group and Lufthansa Airlines has widened. Says overall traffic figures have been strong, but then makes that point about the gap between the two, says that the namesake airline continues to hurt earnings. So a focus on the performance of Lufthansa there. I saw earlier on overnight they were talking about their Middle Eastern operations and extending their suspension of Beirut flights to November 30th. But the subject of this briefing seems to be around the performance of the business. That does not seem to be denting the share price right now, up by over 3%, with the oil price down 1%. Perhaps that has held sway. Let us talk about macro policy, monetary policy. Fed Chair Jerome Powell has emphasised that the overall US economy remains on solid footing, setting the table for further cuts.
Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting.
I'm joined now by Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, for thoughts on what this means for markets. Karen, good to see you. So did you take anything new from Jerome Powell yesterday? I mean, some reports I was reading said, quote unquote, he was a tiny bit hawkish. I'm not sure what a tiny bit looks like to you, whether that's how you describe it. But was it a sort of material update, or is it steady as she goes for you in terms of cuts?
I think the steady as you go part is this whole narrative the Fed have created around our central projection is our war against inflation is won, and therefore we can get back to neutral as quickly as possible. And he reiterated this point about neutral. The Fed, I would say foolishly, give us an assumption of what neutral is. It's much closer to 3. So he's sort of painting this idea that we don't need to be on the brake anymore, so we're just going to ease off and we can get there as fast as possible. Perhaps the slight angle, which is the little bit of hawkishness, is this sort of two-sided risk, and also perhaps that they're not in a major rush. You know, the difficulty when you start off with 50 is that the market, you know, how you control what the market expects about the pace going forward. Yeah. So maybe they're just trying to bring a little bit more gradualism into some of the forward expectations where there's still, you know, an awful lot of very rapid cuts priced.
I don't know whether it's, you know, when is the right time to look back at that 50 basis point cut and say, was it the right thing? When we need maybe more benefit of hindsight. But when you look back, when you look at that now, did it make sense to you at the time? Does it make sense still that they started with 50?
No, if I'm honest. I mean, to me, they really started cutting in December, back when Jay Powell gave us that significant pivot, really gave us the statement that they felt comfortable they were winning against inflation. If you look at what happened to financial conditions from December, they already started really improving. So credit spreads tightened significantly, mortgage rates fell. So the sort of impulse of monetary policy through the economy was already being felt from December because the market priced these lower rates. For that reason, I didn't think they needed to particularly rush. I felt that, you know, you always risk creating a sense of panic. And, you know, some of his statements last night were, look, everything's fine. The US economy is fine. So maybe, again, he's trying to reel back a little bit on that. I didn't see the rush and the urgency, given it was already sort of that 100 basis points was already priced. But, you know, you could argue, look, they're being preemptive. They're getting ahead of the game. They're not taking any risks with growth. Yeah. And that's why the stock market loves it.
Yes. Let's focus a little on Europe and how Europe should respond, because, of course, you know, monetary policy setters, they don't want to just follow each other, but they also don't set policy in a vacuum. Yep. So what does this mean for the ECB then, and with your focus on allocating around European assets?
Yeah, I think the ECB should just get cracking. You know, to me, the US had globally, we had a supply shock. We had a cost shock to inflation. But the fiscal response in the US was so massive that the US also had a demand shock. So the Fed were really right to have to lean hard against that. I think in Europe, yes, you also have to lean against a supply shock. But when it's really clear it's passing through and headline inflation is down, then you start easing. And I think the ECB really need to get cracking. The economy is weak. Just look at the data we're getting out of Germany. And I think now that we will see wage inflation follow headline inflation down quickly. It's a very indexed type of wage negotiation process in Europe. So I think the ECB should get moving now.
Yeah. So what opportunities, with that as the backstory, are there opportunities to invest in Europe at this point, Karen? Is it attractive? I mean, we saw, yes, the PMI data confirmed today for Germany and for France, that very negative story that we saw coming out last week.
Yeah, I mean, we were pretty bullish on Europe at the start of the year for two reasons, one of which is proving right and one of which is proving wrong. So the reason that's proving right is that we felt that we were finally going to get our post-pandemic consumer bounce, headline inflation falling, real wages improving, confidence rising, and that broadly is playing out. The part of the story that is not is manufacturing. We felt also we were going to be on a global goods upturn and Europe was really going to benefit. And that isn't playing out. Global goods demand is still very weak. The weakness of China, I think, is part of that story. We felt that China would have been on a better upturn. So that's proving a bigger drag. But, you know, when it comes down to asset allocation, it's always about what's in the price, not just what the outlook is. And I think if we look at the historic low valuations on Europe, then that suggests there's an awful lot of bad news in the price. And I also think that for investors should be thinking about how to diversify away from the concentration of tech in the US.
Yeah.
And therefore, I think Europe is a good place to go.
Does that take you to somewhere as beaten up as the European auto sector then? I mean, there's certainly a lot of bad news in those prices after the week or weeks that we've had of negative news flow.
Yeah, I mean, there's something else going on here, which is partly related to this goods. I think Europe really is at a bit of a crossroads because I think Europe needs to wake up and realise there's two things the rest of the world is doing that we're not doing. And we think it's because we're being sensible, but we're just destroying our domestic industry. So the two things we're doing are we are, you know, focused on saving the planet and climate regulations and reaching net zero. But when the rest of the world isn't meeting you on those regulations or those carbon pricing, it's really penalising domestic industry. The other thing the rest of the world is doing is handing out subsidies left, right and centre. And we know that Europe was very hesitant to follow the Inflation Reduction Act. We're much more worried about debt levels here in Europe. The rest of the world isn't, you know, so it's like going to a party and, you know, behaving yourself. You know, it's the right thing to do. You're not going to have a hangover in the morning, but the rest of the world's having a better time. So I think Europe really has to think about how it's going to support domestic industry when the rest of the world is doing different things.
OK, Karen, nice metaphor to leave it on. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Thank you for being with us. Coming up on the programme, as promised, we will be live at the Berlin Global Dialogue. Francine Lacroix will be speaking to KKR's Philipp Freise about investment opportunities in Europe. That's coming up next. This is Bloomberg.
Well, good morning, everyone. From the Berlin Global Dialogue, I'm Francine Lacroix. Now, despite the economic doom and gloom in Europe, investors are still looking for opportunities. Now, some of the biggest names in private equity are here at the Berlin Global Dialogue, including Philipp Freise, the co-head of European private equity at KKR. Philipp, as always, thank you so much for coming on. Now, look, M&A in private equity has frankly not been easy. How do you read the situation?
Francine, first of all, thank you for having me. Good morning. Well, as you pointed out, the period between 22 and 24 in the summer was a rather slow period. However, we have experienced a significant uptake now. I think we are up 40% year on year. So as we had previously discussed, that lull would at some point be followed by more activity, and we're seeing that right now.
So where do you see opportunities? And is there still a price mismatch? I remember speaking about this with you as if it was yesterday. Has the buyer's expectations come down?
Well, KKR is constructive on Europe. This year alone, we have invested 25 billion euros here on this continent. Telecom Italia in your country, but also in private equity, a significant equity deployment of 6 billion euros so far this year. And where we see the opportunities, this continent has unprecedented disruption. We have a war, we have an energy transition, we have a technology disruption on a massive scale, and lastly, a generational handover, if you will, that hasn't been precedented here. And people are open for private equity to help them with all of these challenges. So as KKR, we really are positive on partnering with our, potential targets to help them, cope with these challenges.
Philipp, family-run businesses in certain sectors, or just opportunities that look cheap?
So I think, as you pointed out, people are negative on Germany right now. I would be a bit more positive. The innovation power of the German Mittelstand, so family-owned companies, is unparalleled. They have built global niches. Yes, they need to change. Yes, they want to change. But yes, they are also open to work with us. So I'll give you an example. We have just partnered with OHB, the kind of noteworthy German space company in Bremen. The family had 70%, 30% was public. We now took it private. They are still 70%. They didn't sell a share. We took the 30%, and we will help them get into the future in terms of the space economy. They want a partner that is more active than the public markets could be. So to answer your question, it's tech. Space is only part of that tech ecosystem. It's energy transition. You know, Fiesmann did that massive deal with Carrier where they sold their firm, but they are now going back in. They have partnered with us on Encavis, which has 190, new energy.
Philipp, I mean, when you look at Germany, it's seen as a sick man of Europe right now for a number of reasons. We saw, for example, Volkswagen looking at shutting factories, Intel actually not putting that investment straight away that it promised, flatlining growth, if anything. Do you see more opportunities in Germany than elsewhere?
It's a wonderful reminder. Last time Germany was called the sick man of Europe was 2003. And you remember the reforms, the change that was deployed. We helped with that at that time. As you remember, we did many German deals, DMAG, Mannesmann Plastic Machines. I just mentioned Encavis, the energy transition. People call it challenged. I wouldn't go as far as calling it the sick man of Europe because of that energy transition. On the current trends, in 2030, Germany is going to be through with it. But it's a significant investment opportunity which we are helping. I wouldn't call. You saw the deal this morning where ADNOC bought Covestro.
13 billion, so it's not an insignificant deal.
Indeed. People wouldn't invest in Germany if there wasn't opportunity. It still has all the advantages, but it's much more open to change now. It wants entrepreneurial capital, so it's, in our mind, a very attractive opportunity.
How much money do you have to deploy here? I know that you wanted to double maybe some of, I don't know whether it's deals or also staff in Europe to try and find the best opportunities.
Well, KKR has invested in Europe for 25 years. We have not only a private equity business, we have an infrastructure business, a credit business, we have a high net worth, fundraising business. We are all over Europe. We have significant funds. In private equity alone, unlike others, we have a standalone European fund. And therefore, the capital to be deployed here in Europe is not a bottleneck for us. In fact, we want to invest more.
Okay, Philipp, thank you so much. Philipp Freise there, the co-head of European private equity at KKR, stays with us, and we'll talk maybe a little bit about private credit and some of the other opportunities. This is Bloomberg. Welcome back, everyone. We're in Berlin, still with Philipp Freise, the co-head of European private equity at KKR. Philipp, thank you so much for sticking around. Are you seeing increased pressure from investors to actually return capital to them?
Well, we just returned about the impact of this unprecedented volatility. It actually has created now an opportunity to deploy more capital. We are up 40% year on year. But indeed, because of the uncertainty, the IPO markets are still shut, pretty much. There are some timid attempts now for companies to go public, but not at the scale that we are used to. It's still down more than 50%. As a result of that, everybody is finding alternative ways of returning capital. It's certainly up as well in terms of the return of capital, but it's more through longer-term hold periods, selling minority stakes, and yes, strategic buyers also coming back in the market timidly. Indeed, the liquidity that we are seeing more on the buy side is not matched by, liquidity on the sell side. So indeed, that's where we will see more activity. I believe once we have some of the elections behind us, 25, we'll see more activity.
I mean, is that a catalyst? Would that be a catalyst, or do you need something for animal spirits? And does that go through also interest rate cuts?
I think animal spirits always happen. We just talked about Germany, right? If it was true that Germany was so challenged, why do we see all that activity right now with Commerzbank, with Covestro, with our industry being really active? It's because that type of turmoil creates opportunity. So indeed, 25, I think people now discounting very much. We had a Ukraine war. Now we have a very unstable situation in the Middle East. You cannot hope for that year to be without any crisis. But we will have less political uncertainty because some of the elections will be behind us. So yeah, that should be helpful.
Philipp, how does the demand for private credit actually change the multiples or how you look at private equity?
So the credit market is fundamentally changing. Some markets are still very much banked. Japan, which is one of the markets which our industry is very focused on, compared to the US, has a much more banked market still. The institutional market is not as advanced. Germany, similar. Europe is probably in the middle between the US and Japan. Private credit is a significant opportunity in Germany. We have a big business here as well in it, and it's definitely helping German companies or European companies to finance themselves in a more sustainable way, being more independent of the banking market.
Philipp, thank you so much for joining us today. That was Philipp Freise, the co-head of European Private Equity at KKR. Now, coming up, our exclusive interview with Thomas Schinecker, the chief executive at Roche. The pharma giant talks to Bloomberg's Anna Edwards to discuss the firm's industry outlook, new drug development, and more. That's next, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacroix, who is with us, of course, as you just saw. She's at the Berlin Global Dialogue. More from Francine as we go through the programme. These are your top stories this morning. Dockworkers walk out of every major port on the US East and Gulf coasts, threatening the world's largest economy weeks before the election. Israel says it has begun targeted ground raids in villages close to the border in southern Lebanon, despite international calls for restraint. And you're looking at live pictures from Brussels as the former Dutch Prime Minister Mark Rutte has succeeded Jens Stoltenberg to become the Secretary General of NATO. Let's move on to corporate news flow. And the Swiss drug maker Roche says it's aiming to deliver 20 new medicines to address diseases that rank among the biggest burdens to society this decade. The new goals are the result of a more than year-long overhaul of the company's research and development, as Chief Executive Thomas Schinecker targets a fresh direction after a series of failures in cancer and Alzheimer's disease. I'm pleased to welcome Thomas Schinecker to the programme for an exclusive conversation. Very nice to have you with us. Thomas, thank you for being here with us in London. I know you've been talking to investors, presenting your new plan. If I could zoom in on one area of focus, because the market's got itself very excited about the potential for obesity drugs. You are in this space. You did a deal with Carmot. What space do you think there is for Roche, given how busy it is with lots of other competition for obesity treatments?
Well, obesity will make up about 50% of the world's burden in terms of the population. So 50% of the world's population will be obese in their 30s. So that's a huge problem that we have to face as a society. The issue with obesity is that it doesn't only affect, the fact that people get overweight, but actually the problem is that it affects so many other diseases. Diseases such as cardiovascular diseases such as cancer. We know that people that are obese develop a higher chance for getting cancer. Other diseases like Alzheimer's, Parkinson's disease. So you see a big link between obesity and a number of other diseases.
And that's the urgency, but there's a lot of GLP-1s out there on the market already. You've got your own play. What space do you think there is for Roche in this?
Well, on the one hand, we have very good molecules which have a very high efficacy, and they're very differentiated. We have an oral version and injectable version. And on top, we believe that the medicines that are currently on the market will actually not serve all the needs that patients have. For example, there is a reduction in muscle mass in patients with the current medicines. So how do we fix that, right? How do we fix that people can stay at the level once they reach the level that they need to reach? Yeah. So there are a lot of opportunities to address that. And on top, co-formulations with other medicines to tackle diseases in the heart, but liver, kidneys, etc. So we believe it's kind of a backbone in order to address a number of different healthcare challenges in the world.
So is this a deal story for Roche? Is this something that means you have to go out there and buy other businesses to play your role in this space?
No, in fact, when we did the acquisition, we saw that we had more than 5 different medicines that we actually want to combine the GLP-1s with. So we actually have a very good pipeline that fits to the GLP-1 GIPs.
Okay, and when you brought out some early stage data quite recently, we saw the shares rise on the back of that, but then the shares went down again on the back of some further data and some further news. The market is very volatile around these kind of research reports. Are you learning quite a lot about the best way to communicate to the market around this exciting but also slightly hyped sector?
Yeah, so whenever we have news in-house that could be market relevant, we have to communicate it. It's a legal requirement. So that's why we very much keep to what our legal colleagues tell us. And we saw it, right? We saw that once we communicated, there was a lot of, happiness and support about these kind of molecules coming to the market and having more options than just the 2 options that are available today.
Yes. Regarding
the later data that was published, one thing that people have to be careful of is not to compare apples with pears, right? This was stage 1 data. In stage 1, you actually uptitrate very fast the dose, which you would not do once you give it to patients once the medicines are on the market. So you can really make sure that the tolerability is in a very good shape if you titrate slower, and it has no effect on efficacy because the efficacy is really specific for the molecule itself.
Okay, yes, because that second part of the conversation was more about the ability to tolerate the medicines and how people might respond.
And they're very tolerable once you uptitrate slow.
Okay, again, just lingering on this for one more question. Zealand Pharma in focus for some people, and they have an amylin asset that you don't have. From what you've said, it doesn't sound like you want to do more deals in this sector, but some analysts are talking about whether that kind of company might be an attractive partner of some form for you.
Yeah. So we have a number of different molecules in our portfolio right now. Some of them we've disclosed, some of them we have not disclosed. So we have never said we don't have an amylin in-house. So that's the first piece. The second piece is we have, for example, an anti-latent myostatin antibody. This antibody actually helps to preserve the muscle mass for these patients. Again, the problem with patients who take these GLP-1s is they lose a lot of muscle mass. So once they stop taking it, it's worse than before because the metabolic rate has gone down even further because they need the muscles to burn that. So we have a really great asset in-house we want to combine this with. Plus, yesterday, our head of development for the cardiovascular metabolic franchise presented data on one more asset that we have not yet previously shown to the outside world, with which you can even get deeper response in terms of weight loss. So we have a number of things in the pipeline. Some of them we've shown.
Yes.
2 of the examples I gave. A lot we have not even disclosed yet.
Okay, so it sounds like you don't need M&A on obesity.
Well, look, we are always open to look at things, right? I think that's part of the job that we have.
Yes.
We always need to look at different opportunities, but we say no to 99.999% of the topics. There.
Okay. We are moving towards a US election, of course, and drug pricing often becomes topical. And in the run-up to that, we're seeing quite a lot of pressure on those that already play in this sector, that taking part in hearings in Washington, for example. On US drug pricing, is that, and the fact that we might see negotiations around pricing on Wegovy as early as 2025, is that influencing your thinking around the opportunity in this sector at all?
Well, first, we're an international company. So we don't only look at the US when we look at serving patients' needs. Second, in the US, we have a tradition and a history that we've always priced our new medicines below the standard of care. So we are definitely taking our responsibility to make sure that there is the right pricing in these markets.
And looking at other drugs and other opportunities, you've also indicated, I started this conversation talking about a whole range of diseases and things that you want to tackle. You've indicated an interest in antibody drug conjugates for cancer. I wonder what opportunities you see within that space.
Yes, so we just recently did a deal for ADC, so antibody drug conjugate for CMET. So there is, it's an interesting space, and we have a couple of things in our pipeline, but it's also a space which we have recently seen. It doesn't mean that everything is going to work. So you have to have your due diligence, you have to go through the different stages of clinical development, and then you have to pick the right ones. And so it's not a home run as we've seen lately as well.
Thomas, thank you very much. Thank you for joining us. Good to speak to you as you pass through our offices here in London. Thanks to Thomas Schinecker, the Roche CEO. Coming up in the programme, we will be hearing from Eric Cantor, Vice Chair of Moelis and former Majority Leader in the US House of Representatives. Stay with us for his thoughts on the US port strikes ahead of tonight's vice presidential debate, of course. He'll be speaking to Francine shortly. This is Bloomberg.
Welcome back, everyone. Now, dock workers have walked out of every major port on the U.S. East and Gulf Coast in a dispute over their wages and contracts. Now, the strike could add uncertainty to the U.S. presidential election and comes ahead, of course, of tonight's vice presidential debate between Tim Walz and J.D. Vance. Well, joining us now is Eric Cantor, Vice Chair and Managing Director of Moelis, a former Majority Leader in the U.S. House of Representatives. Thank you so much, Speaker Cantor, for joining us. I mean, there's a lot going on in U.S. politics, and the strikes certainly add a lot more strife and uncertainty to it. How do you see it playing out?
Well, Francine, it's great to be with you. I mean, unquestionably now, as we see the dock workers go on strike in our country, it is going to add just yet more pressure to the economic worries that are at the heart of this election battle. As we know, this administration has been battling with pretty significant inflation that's impacted working families across the country. And if the two sides are unable to resolve the dispute around the dock workers and the ports in our country, you're talking some significant inflationary pressures and some backlogs in terms of supply chains in the country. So I don't think it's a good turn of events for the Biden administration and for the Harris campaign right now.
You have two candidates, two different economic agendas. How will they change their policy to deal with strikes like this?
Well, I think what is sort of the new arrival of a new situation where you actually have President Biden, he showed up on the picket lines, as did President Trump over the summer when the auto workers had gone on strike in Detroit. So increasingly now there is some type of relationship and or support that both sides are giving to workers as they face the rise of cost of living across our country. So again, this is the heart of what the election's about. And why I think that Kamala Harris is on significant defense on the most important issue this election, which is inflation in the economy. And this port strike certainly doesn't help matters for her campaign.
Why is U.S. debt actually not being talked about in this presidential campaign on either side?
Well, it is an amazing thing right now, given the type of debt and deficit that the U.S. Is incurring. This year, we will be at about 3% of net interest costs to GDP. And that is historically the point at which there is a fiscal reset in our country. I do not think that there's a will for that to happen at the policymaking level, even after this election with the installation of the new Congress. And I think, Francine, somehow or another, it's because the U.S. economy has proven continued to be resilient with the creation of more jobs. Obviously, it's a much more constructive environment from a business standpoint going forward with the inflation coming down. Interest rates, obviously, the direction of which has now been signaled by the Federal Reserve. I think all that adds to really investor confidence about the United States.
Look, you've had some harsh words about President Trump. Do you still recognize your Republican Party?
Listen, I'm a Republican. I think President Trump will win this election. It is very, very close right now. And again, the terms of this election are really about the economy. It's really about whether the American people are going to want 4 more years of the same, which is essentially the message you hear from the Trump-Vance campaign. and or whether the country is going to take a step towards trying to restore some type of confidence and strong leadership. I mean, that's really what's on the ballot in the next 5 weeks. We're 5 weeks out from the election. And certainly the party has taken a much more nationalistic turn, but I think that is true globally. Right now we see increasing sense that we have to secure our supply chains. After the COVID pandemic, we certainly were awakened to the fact that China is a serious issue for the world and our supply chain, and certainly from a national security standpoint, our foreign policy has become increasingly focused and prioritized on the issue of the U.S.-China relationship, and that will continue.
President Trump is also talking about putting in question the independence of the Fed. There's talk about 100% tariffs on nations that don't comply with the U.S. demands. Do you have worries about some of the rhetoric around this campaign?
You know, if there's one thing that President Trump has been consistent about, I think pretty much throughout his business career as well as his time in the White House, has been on the issue of trade. He has consistently made the point that we in the U.S. have been put at an unfair advantage after the end of the last World War, and certainly after the demise of the Soviet Union. I think people were lulled into this notion that somehow globalization was going to cure all ills, and that somehow we didn't need to worry about our defense spending, our industrial base. All those things have sort of come to roost now, and realizing that all this costs a lot of money. And as our country looks to try and make those investments, I think what President Trump's argument is that others ought to step up and pay their fair share. And I think that's where his position on the trade and the tariff issue comes into play. So long as others are trying to step up and pay their fair share and pull their own weight, as we all gather together towards the increasing threat situation globally, I'm not too worried that ultimately those tariffs will actually be something that come into existence and last. We'll see.
But what does this America First policy mean for the rest of the world? And overall, if governments across the world are now prioritizing national security objectives over economic efficiency, does it mean that the rest of the world and even U.S. allies will break away from the United States of America?
Well, you know, I think what has been going on post-World War, and certainly as we've all sort of benefited again from that post-demise of the Soviet Union, you know, I do think America has been central to the defense of international trade, to the open and accessible sea lanes, to the implementation of international law and the sort of normal rules that we've all become used to. But again, it's increasingly a global situation where countries are going to look to see what's in their own best interest, and they're going to look to count on the alliances that America has sponsored. And I would say, even though some of the rhetoric seems like America is going to go things on its own, overwhelmingly, I would say in my party, there is a strong sense of American leadership globally. And we've seen that play out in terms of the vote to support the effort by Zelensky in Ukraine. We've seen that in terms of the vote of support in terms of the Republican Party and, frankly, the Democratic Party in its support of Israel in its ongoing war with the Iranian proxies that are implementing Iran's Ring of Fire strategy in the Middle East. And I think that you're going to continue to see that kind of support coming from Capitol Hill, despite some of the rhetoric from the current White House with Joe Biden.
Eric Cantor, thank you so much for joining us today, Vice Chair of the investment bank Moelis and a former Majority Leader in the U.S. House of Representatives. Plenty more to come right here from the Berlin Global Dialogue, including more of our interview with the BlackRock Chief Executive Larry Fink. This is Bloomberg.
I am a very large believer on a banking and a capital markets union. I think that's the strength of the United States. But Europe needs to do that. I've read the Draghi report. Because we are large shareholders in both, I don't talk about any activity about one organization versus another. But technically, I look at the strength of the United States, and much of this strength is because of the strength of our capital markets and our banking system. Europe needs a stronger capital market system, and it needs a more unified banking system. And I think that's going to be urgently necessary for Europe to go to the next step.
Well, that was the BlackRock Chairman Larry Fink speaking to me a little bit earlier. Joining us now is Chad Thomas, Bloomberg's executive editor for Europe. Chad, you're here also based in Berlin. Thank you for joining us. There's a lot going on with some of the German companies. I think ADNOC just made a big play, a 13 billion acquisition here in Germany. UniCredit is definitely going after Commerzbank. Where are we on German business?
Yeah, you have these German businesses that are in play where you have Covestro, ADNOC buying them. You have UniCredit trying to purchase Commerzbank. So there's a bit of concern in Germany about these businesses potentially being bought up and who's going to own them. At the same time, you also have issues with the German automotive industry. The German automotive industry, you can't underestimate how huge it is. 800,000 people are employed in this country in the automotive industry when you think about the suppliers and everybody else. And all of the German car makers are struggling. They've all issued profit warnings in the last couple of weeks. They're all struggling with the shift to electric vehicles. And most importantly, China. They're not doing well in China. China is their biggest market by far. Also the big profit center. That is where they used to draw in all the money regardless of what was happening everywhere else. They're struggling in China. They're not doing well with the EV transformation. And so you see the likes of Volkswagen saying that they may, for the first time, have to close a plant in Germany. They're also talking about doing away with some of these agreements that they have with workers that have been in place for decades in Germany. So you see a real shift happening in business here and also in the society as a whole.
Yeah, and this is against a very difficult political backdrop. I know you and your team yesterday broke the story that the German government is not really expecting any growth in the country.
Yeah, so we had the scoop yesterday that when they come out with their new forecast, they're likely going to forecast that it will be stagnation. In a way, it's not really a surprise because that's what a lot of others have been saying. It's the German government, in a sense, catching up. But what has happened, you've seen the rise of populism in this country. We've had 3 state elections in eastern states, and the far right has done very well. Also, the far left has done very well in these elections. And so the chancellor is really struggling to get through with his message. All of the parties in the coalition are doing very poorly at the moment. The Greens, who are in the government, they just tossed out all of their leadership. And we're 1 year away from a federal election. So it's interesting to see what's going to play out in the next year.
That's the understatement of the year. It's interesting. Chad Thomas, thank you so much. Chad Thomas, Bloomberg's executive editor for Europe. Up next, it's Bloomberg Brief, Danny Berger and Manus Cranny in New York. And this is Bloomberg.